You're telling me strategy's chance of default goes up with more time, when in more time we actually expect Bitcoin to be even better of an asset? So then I think people will have this aha moment, which is Bitcoin has always had a backwardation to its risk spectrum for some who understand the relationship between Bitcoin and fiat. It's more likely, in our opinion, that credit risk for strategy goes down in 5 years and in 10 years because of Bitcoin's performance relative to fiat. So the credit spread itself implying what B minus means across the contango of generally what a default curve looks like is, I think, showing folks that it's not a compatible framework.
The S&P report on Strategy's Bitcoin holdings exposed more than just a credit rating. It revealed a clash of financial worlds. Jeff Park, a Bitcoin-focused investment strategist, argued that the analysis underscored how deeply incompatible Bitcoin's decentralized, liquidity-rich design is with the rigid, intermediary-based frameworks used by traditional insurers and rating agencies. While the B grade might have seemed arbitrary, perhaps even a subtle nod to Bitcoin to be continued, Park viewed it as a sign that legacy finance still struggles to measure innovation using outdated tools. Yet, he credited Michael Saylor and the strategy team for breaking new ground, pushing Bitcoin into the conservative realms of credit and insurance where it had never been formally tested before. At the center of the issue, Park explained, lies the calculation of risk-adjusted capital. By treating Bitcoin as an intangible asset, like goodwill, S&P effectively erased its value from Strategy's balance sheet, even turning equity negative. This accounting logic, he argued, fails to recognize Bitcoin's liquidity and market depth features that make it more tangible and tradable than many traditional assets. The outcome was less a reflection of Strategy's true financial health and more a demonstration of how conventional capital models fail when applied to decentralized, non-sovereign assets. Park also criticized S&P's approach to operational risk, where the agency penalized Strategy for self-custody, seeing it as a cybersecurity liability rather than a structural advantage. In doing so, he noted, rating agencies are implicitly endorsing the very middlemen Bitcoin was created to replace. This contradiction, he argued, exposes a fundamental gap between old and new systems of trust. Until underwriting standards evolve to account for Bitcoin's unique properties, Park warned, traditional finance will continue to misread its risks and miss its potential. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Well, first of all, I think it's so funny when you read the report and you realize there are so many things about it that hint towards the lack of compatibility with the Bitcoin business model that Strategy is pursuing and the insurance framework, that B minus itself just feels a little random. Like, why B minus? Sounds like from all the reasons it might have been a C. And I thought maybe it's B minus because it's Bitcoin to be continued. And that was a clever way to make a nod at it. But all kiddings aside, look, I'm very happy for Strategy. I know it's been something the Saylor and team have been working on for a long time, and we owe them a ton of gratitude for pushing the industry forward, because insurance is the holy grail of capital costs, to which I think Bitcoin serves a really useful role as a very long duration asset, which is exactly what insurance should be pursuing. But at the same time, rating agencies are growing and changing and fallible. And, there's a wonderful quote from Warren Buffett, actually, back in 2008, when in his annual shareholder rotor, he said, ratings agencies are a prime example of people who don't know what they don't know, and everyone trusts them anyway. And there's a certain truth to that. And I think the Strategy research report shows you exactly what those gaps are. So I'll point out a couple of things, and we can double click on which ones you think are most interesting. The most glaring aspect of it that I think most asset owners would recognize makes Strategy very challenging to grade in the credit model that insurance companies are used to is the concept of RAC, risk-adjusted capital. So risk-adjusted capital is important because it is trying to assign a quality grade to assets to which there's bifurcation between good assets and bad assets. And it's a little bit of a combination of the Basel framework It's a little bit of the OCC and FDIC with the Fed. It's a little bit of NAIC. And it's all of these bodies combined trying to think of what are assets ultimately worth and how can we penalize or reward good assets versus bad assets. The two parameters that tend to dictate this, which wouldn't surprise anyone who's been following crypto, is liquidity and volatility. So if it's very illiquid, you get pinged. And if it's very volatile, you also get pinged. So Bitcoin sits in this really strange medium where we know it's volatile, but we also know it's very liquid. And again, as we've talked about before, those two things don't generally come hand in hand. It's usually very volatile because it's really illiquid, or something that's really liquid tends to be very not volatile. So Bitcoin's a corner case. And so what happens is that to calculate the RAC ratio, you take the risk-adjusted capital, you divide it by the risk-weighted assets. And the problem that strategy has faced is that the S&P has determined that their risk-adjusted capital is negative. It's actually not just even a small number, it's negative. And the reason it's negative is because you took the equity value and you subtracted all of the Bitcoin assets and therefore flipped it into a negative territory. They subtracted Bitcoin because they classify Bitcoin as intangible assets. And a certain category of intangible assets can also be called non-capital assets. And generally, those classifications are used for things like goodwill, right? So if you have goodwill on your balance sheet through mergers and acquisitions, very hard to put value on it. Of course, it's really illiquid. You can't trade intangible assets of that kind. So you have to take it back out of the equity, which I think is fair. But it's not fair to call Bitcoin goodwill. That's essentially what they're doing, because Bitcoin, as we know, has value. It has liquidity, and it has all the features of what should be more treated as a way collateral is otherwise haircut or promoted in different regulatory frameworks. So that part, I think, is a fundamental chasm. It's a true gap. And once you go into negative territory because of that, nothing will make sense. The other part that I thought was really kind of interesting, and this is more for kind of the meta of what rating agency ultimately stand for, is they heavily penalize strategy for the operational risk vector for which they are custodians of their own assets. And therefore, they have cybersecurity risks. And their cybersecurity risk is pretty profound because if they were to lose controls of their private keys, their whole business would be at stake. I'm a little sympathetic to this kind of operational issue that rating agencies have not dealt with. But at the same time, the territory now that we're going into is rating agencies specifically telling you that self-custodial solutions are bad, right? It's this idea that things need to be intermediated more, and you actually do want more middlemen and all these things, which is exactly what Bitcoin is trying to be an attack vector for. So that being also a penalty when in some sense could also be perceived as an asset if you're truly risk remote from having intermediation, which makes it a more kind of robust security to hold on your own balance sheet. One could imagine that could also be a plus, but again, it requires like a total reset of your mindset and a regime of underwriting.
Jeff Park emphasized that understanding how rating agencies evaluate Bitcoin is crucial for predicting the next steps in its mainstream adoption. He explained that under current frameworks, corporations holding Bitcoin face severe accounting penalties, its value written down to zero or even treated as a negative on the balance sheet. Such treatment deters blue-chip companies from adding Bitcoin to their reserves, as it could harm their credit ratings. Park argued that this logic is fundamentally flawed since Bitcoin's risk profile should improve, not deteriorate, over time as the asset matures and strengthens relative to fiat currencies. This contradiction, he said, reveals how deeply misaligned conventional credit models remain with Bitcoin's long-term, anti-inflationary design. Despite these shortcomings, Park viewed the report as a step forward, noting that Bitcoin's inclusion in institutional credit discussions marks a turning point in financial recognition. While the B rating reflects traditional biases, its mere existence signals Bitcoin's entry into the formal structures of risk and credit evaluation. He argued that markets, not rating agencies, will ultimately determine the fair risk premium and clearing price for such assets, suggesting that as investors better understand Bitcoin's fundamentals, its perceived credit risk will naturally decline. Let's get back to the interview.
Definitely learning how they're thinking about it is important because how they're thinking about it helps us anticipate what the next incremental progress has to be made for the industry to advance. So we already know that accounting rules have gotten easier with ASC 820 clarifying on how to treat assets that basically have to be measured at fair value. We know that the CAMT guidance that has been coming out of Treasury and IRS is also permitting the possibility of Bitcoin adoption on corporate balance sheet. But the third vector is insurance and credit risk. This is actually one of the hurdles to having more corporates buy Bitcoin on their balance sheet. Take, for example, Apple, right? Apple has billions of dollars of cash on its balance sheet. What this report just showed you is, hey, Apple, if you go buy Bitcoin on your balance sheet, not only are we going to just reduce that to zero, we're going to turn that into a negative number and double hit you with it. So when you see stuff like that, and you're just a normal corporate who wants to get credit rating, you're going to be like, I'm not going to buy Bitcoin on the balance sheet because now I just realized this is going to hit my credit score in a way that is so detrimental. And so it's really important. And it's a good thing that we now know how they're thinking about it. On the other hand, it's a huge hindrance. I think now this is very clear that most companies who are blue chip are not going to buy Bitcoin on their balance sheet because what we just saw in the treatment was so incredibly unfair. At the same time, for strategy in particular, getting an actual rating assignment is important. And for that, again, I think it's a worthwhile thing that Saylor did. I'm very grateful for what he's done for the Bitcoin treasury space and crypto at large, mainly because now we can still contextualize what the risk spectrum of Bitcoin adoption means to other players in this space. So what does that mean? B minus is fairly severe in its categorization of high yield. It is speculative. It is maybe 5 or 6 rungs below investment grade. So it's not great, but there's numbers associated with this, right? B minus is about 10 to 12% of a credit spread. It's actually kind of what the prefs have historically been pricing regardless with the converts, which again, I think is how S&P ultimately backs off to B minus. I don't think they actually did it bottoms up. They just did top down and looked at where the rest of the capital structure is trading and saw, oh, it fits in this box. It must be B minus, which in itself, if you think about it, is kind of hilarious. But that's important because it helps people think about what that 10 to 12% risk premium can mean. So 10 to 12%, that's probably about 4 times a regular high yield, maybe 8 times investment grade in credit spread, and it implies about a 10% chance of default over a year and over a 5-year period, and it implies maybe a 30% chance of default over a 10-year, 45-50% chance of default, and so it's good. People should think about these kinds of things. What I think though, then people will realize is, wait, what Jeff just said makes zero sense. You're telling me strategy's chance of default goes up with more time, when in more time we actually expect Bitcoin to be even better of an asset? So then I think people will have this aha moment, which is Bitcoin has always had a backwardation to its risk spectrum for some who understand the relationship between Bitcoin and fiat. It's more likely, in our opinion, that credit risk for strategy goes down in 5 years and in 10 years because of Bitcoin's performance relative to fiat. So the credit spread itself implying what B minus means across the contango of generally what a default curve looks like is, I think, showing folks that it's not a compatible framework.
Like, we are moving in the right direction.
100%. And this is exactly what Saylor is really good at, right? He figured out MicroStrategy for the first wrapper of Bitcoin holding when Bitcoin ETFs were not possible. And it was like, just give us a shot, let us play. And then it proved its case. I think ratings agencies now coming in to at least let us be in the arena is the most powerful thing that could have happened. So regardless of what the report says, regardless of its fallible arguments, regardless of whatever perverse incentives might now arise out of other corporates being able to buy Bitcoin on the balance sheet, putting that all aside, I think the market will determine what the risk clearing price is for the kinds of considerations that they want to be paid for. And my feeling is that the B minus ratings category strategy will stand out versus its other peers that I do believe are truly speculative in the nature of their credit because of their capex or because of the cyclicality of their business. Strategy is a very robust capital structure, and smart money managers will come around and see it, and then we'll push it forward.
Traditional credit and insurance frameworks continue to misunderstand Bitcoin's unique characteristics, treating it as an intangible, high-risk asset rather than recognizing its liquidity, transparency, and long-term value stability. By classifying Bitcoin holdings as a liability or reducing them to zero on corporate balance sheets, rating agencies inadvertently discourage institutional participation and innovation. This misalignment stems from systems built for intermediated, fiat-based finance models unable to capture the decentralized and self-custodial nature of digital assets. Yet, the fact that Bitcoin is now being formally assessed within credit structures marks a critical milestone, signaling the beginning of its integration into mainstream financial evaluation. As markets gain a deeper understanding of Bitcoin's performance and resilience, traditional risk models will need to evolve, acknowledging that over time, Bitcoin's strength lies not in speculative volatility but in its enduring role as a scarce, trust-minimized, and inflation-resistant asset. How might credit rating agencies need to adapt their evaluation frameworks to more accurately assess decentralized assets like Bitcoin without relying on outdated fiat-based risk models? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.